In the spring of 2012, Facebook bought a 2-year-old photo sharing app called Instagram for $1 billion. And, the number itself obviously made headlines, but the actual shockwave that really hit the tech industry was the headcount.
Right. Yeah, the headcount was wild.
Yeah, because Instagram had 30 million active users, 0 revenue, and exactly 13 employees. So Facebook essentially paid roughly $77 million per employee.
Which, at the time was viewed as this absolute miracle of modern capitalism. I mean, financial analysts treated those 13 people as the absolute zenith of software efficiency. Yeah. It's sort of the ultimate proof that a tiny, hyper-concentrated team could build an asset of just monumental global value.
But looking at that from our vantage point today, in this current landscape, those 13 human employees do not look like a miracle of efficiency anymore. They actually look like a bloated legacy bureaucracy.
Yeah, it's a completely different paradigm now. The goalposts for economic leverage haven't just moved. The entire stadium has basically been demolished and rebuilt on a completely different planet.
Exactly, because the new event horizon of the global economy, like the absolute limit of capitalist leverage, is the one-person unicorn. So that's one single human founder, 0 human employees, and a $1 billion valuation powered entirely by an autonomous AI agent swarm.
It's staggering to even say out loud.
It really is. Welcome to MediaGenX. We are independent analysts, and today we are tearing down the physics of extreme economic leverage.
Yeah, we are mapping out the mathematical inevitability of the algorithmic enterprise.
Yeah.
We're going to define exactly how close we are to seeing one of these in the wild, and we'll actually outline the step-by-step architectural blueprint to build it.
Okay, let's unpack this. Because building an empire alone sounds like this perfect utopian dream until you realize the terrifying reality of actually operating it.
Oh, absolutely.
I really want to get into the psychological toll of what we call God mode. Like, what actually happens to a human mind when you operate entirely alone in a command center and a single algorithmic hallucination could, accidentally wire $10 million to a sanctioned entity in North Korea.
Yeah, the risks are just astronomical.
Right. We are definitely going to get into that dark side. But before we get to the psychology or even the underlying technology, we really have to look at the money angle. I mean, why would the market ever value a solo operation at $1 billion in the first place?
So to understand that, we first have to cure ourselves of a biological bias, because human beings are evolutionary wired to equate physical mass with power.
Oh, that makes sense. Like the bigger, the better.
Exactly. We see a sprawling global supply chain, 10,000 employees, a massive glass and steel headquarters in Manhattan, and our brains instinctively categorize that as a highly valuable, durable business. We just assume headcount equals value.
But the stock market does not care about your glass headquarters.
No, not at all.
The financial markets value an asset based on a ruthless, undeniable mathematical formula, right? It's projected future free cash flow, multiplied by a growth rate, and discounted by risk. That is literally it.
That's it. So let's run a side-by-side comparison to really illustrate this. Let's look at 2 hypothetical software companies, and let's say both generate $10 million in annual recurring revenue, or ARR.
Okay, 10 million ARR.
Right. So company number 1 is your traditional legacy SaaS business. To build and maintain that 10 million in revenue, it employs, let's say, 50 engineers, 20 salespeople, 10 middle managers, plus HR and legal.
So they have massive, massive overhead.
Huge overhead.
Let's say their profit margin is a very respectable 20%, because that's standard, right?
Sure.
Out of that 10 million, they generate $2 million in actual profit. And in a standard tech market, investors might apply a 10x multiple to their revenue. So company number 1 is valued at $100 million, which is not bad.
No, not bad at all. That's a great exit for a traditional founder.
Yeah.
But now let's look at company number 2, which is the solo founder AI SaaS. So this founder builds a highly specialized B2B software platform that also generates $10 million in ARR.
Right.
But instead of an 80-person payroll, this founder uses an autonomous AI swarm for code generation, customer support, and outbound sales. The human payroll is exactly 0.
Wow. So their only operating costs are basically just cloud compute, server space, and API calls to the underlying AI models.
Exactly. And let's be generous and say that costs $500,000 a year. That leaves a profit margin of 95%.
95%? That's insane.
Right. This solo business generates $9.5 million in pure, unadulterated free cash flow.
Okay, so if we connect this to the bigger picture, the way capital markets react to that 95% margin changes the entire valuation physics.
Yes.
Because capital efficiency is effectively infinite at that point, investors aren't going to just assign a standard 10x revenue multiple, right? Wall Street assigns massive premiums to hyper-profitable, infinitely scalable assets.
Right, because there's no friction to scale.
Exactly. So that solo business might trade at a 30x or 40x multiple of revenue. Suddenly, the solo founder's $10 million business is valued at $300 to $400 million.
And here is the kicker for reaching that $1 billion unicorn status. They only need to scale that AI swarm to reach about $30 million in ARR.
Wow.
They don't need to interview 100 new sales reps. They don't need to open a London office. They don't need to hire a VP of culture to manage morale.
Right. Scaling revenue simply becomes a matter of provisioning more cloud compute resources. It's just a slider on a dashboard.
It is so counterintuitive.
Yeah.
Because we are conditioned by, every business book ever written to think of growth as human expansion. You hit a milestone, you hire a team.
Yeah, headcount is a vanity metric in Silicon Valley.
Exactly. But in this new math, humans are actively degrading your valuation. Yeah. Humans introduce friction. They demand equity, which dilutes your ownership. They get sick, they form silos, and fundamentally they put a hard ceiling on your profit margins.
It's funny, the illusion of the 20th century corporate world was that human labor was the engine of scale. But in the agentic economy, the one-person unicorn is really the mathematically perfect expression of leverage. It's the total decoupling of revenue generation from biological labor.
Which is a wild concept to wrap your head around.
It is, and I hear that, and the spreadsheet math makes perfect sense, but spreadsheets don't build software. So let's ask the obvious question that everyone listening is probably shouting at their steering wheel right now. Has anyone actually pulled this off? Are we talking about a theoretical white paper here, or are there solo founders out there right now operating at this scale?
So we have not yet seen a verified public billion-dollar acquisition of a strictly one-person company. We are standing on the exact edge of the event horizon. But the prototypes, the apex predators of this new model, they absolutely already exist.
Okay, let's look at the real numbers then.
Yeah, so take Peter Levels. He is the solo founder behind platforms like Nomad List and Photo AI.
Oh yeah, he's famous for this.
Right. He operates with virtually zero full-time employees, relying heavily on automation, AI tooling, and just an incredibly lean tech stack. And he is generating over $5 million a year in pure profit.
That is just wild.
Now, he's a multimillionaire, not a billionaire, but he proves the core concept. He proves that a single human can architect a multi-million-dollar recurring revenue machine completely alone. And
if we want to observe the revenue scale side of the equation, we can look at Midjourney, right? The AI image generation platform. They recently hit roughly $200 million in annual revenue.
Which is staggering.
With a team of, 40 people? Somewhere right in that range, yeah. Which translates to a mind-bending $5 million in revenue per employee. They are valued in the billions. And while it's not a solo operation, the sheer density of their financial leverage proves the foundational thesis.
Actually, my favorite example comes from completely outside the traditional tech startup space.
Oh, the quantitative finance guys.
Yes. Look at what are known as ghost companies in the quantitative finance sector. There are solo quantitative traders out there managing hundreds of millions of dollars in capital.
Right.
They use highly complex autonomous algorithms to execute high-frequency trades. Some of these individuals have already crossed $1 billion in personal net worth, and their entire company is literally just a Delaware LLC and a server rack in New Jersey.
And it makes sense that the financial sector adopted autonomous wealth generation first, right? Because trading is completely native to digital environments. There are no physical supply chains to manage.
But software is now catching up. We do have to address, though, why the one-person software unicorn hasn't quite crossed that billion-dollar finish line yet. Because historically, two massive technical and social bottlenecks stood in the way.
Right, which are context window limitations and enterprise trust.
Exactly.
Let's break those down because the tech jargon gets a little thick here, and I want to make sure we're totally clear. Context window limitations were a massive roadblock even just a year or two ago. For anyone not deep in AI architecture, the context window is basically the AI's short-term memory.
Yeah, think of it like the RAM in your brain.
Right. Early models could only remember a few pages of text at a time. So if a solo founder asked an AI to manage a massive enterprise software product, the AI would literally just forget how folder A worked while it was trying to write code for folder B.
Right, it would just drop the context completely.
Yeah, it would hallucinate, the code would break, and then the human founder would have to spend 40 hours debugging it.
So the solo founder essentially became the bottleneck of their own automation. They were trying to manage a hyper-intelligent employee that also happened to have severe amnesia.
Which defeats the whole purpose of the 95% margin if you're working 100 hours a week debugging.
Exactly. But that bottleneck is collapsing as we speak. I mean, we now have models with million token context windows. They can hold entire libraries of code in their working memory at once. But even more importantly, we have Agentic RAG.
Retrieval augmented generation.
Right. RA is the critical breakthrough here.
Let's explain RAG clearly, because this is really the secret sauce of the whole swarm. If the context window is short-term memory, RAG is like giving the AI an open book test and an ultra-fast robotic librarian.
I love that analogy.
Right. Instead of trying to memorize a 5 million line code base, the AI agent dynamically searches your database, finds the exact 3 lines of code it needs, retrieves them, and uses them to write the new feature without hallucinating. The amnesia problem is completely solved.
Which is huge.
Yeah.
And that leads us directly to the second bottleneck, which is enterprise trust. Because let's say the RG sister works perfectly.
Okay.
You, as a solo founder sitting in your bedroom, have built a flawless, highly secure enterprise software product. A Fortune 500 bank is still not going to buy it.
Because enterprise procurement teams are paid to avoid risk. They don't buy software from a bedroom.
Right, they want a vendor they can vet.
They demand SIC2 compliance audits, they want dedicated human account managers, massive legal indemnification clauses. They essentially want a heavy corporate entity on the other side of the table, so they have a throat to choke if things go wrong.
That's the exact phrase they use, yeah, a throat to choke. But that barrier is also disintegrating right now. Enterprise trust is rapidly being replaced by cryptographic proof.
Okay, how does that actually work in practice? Like, if I'm selling my software to JP Morgan, how do I replace a steak dinner and a handshake with cryptographic proof?
So think about what SOC2 compliance actually is at its core. It's a massive, months-long audit of a company's security controls, usually conducted by human accountants reviewing endless spreadsheets and server logs, right?
Great. It's a very painful process.
Extremely painful. But today, we have automated AI auditors. The bank's procurement system can instantaneously ping your software's architecture, verify your encryption protocols, check your real-time uptime logs, and validate your security compliance cryptographically.
Oh, wow.
So the human element of trust, that steak dinner handshake, is being completely replaced by zero-knowledge proofs and localized instant audits.
So the bank doesn't even need to trust me, the human. They just verify the math of my software.
Exactly. Trust becomes a math equation, not a social dynamic.
That is wild. Okay, so if both of these bottlenecks, the memory limits and the enterprise trust, are essentially solved, where does that put our timeline?
Well, based on the current velocity of agentic deployment, the first official verified one-person unicorn will likely emerge within the next 18 to 24 months.
18 to 24 months.
Yeah, the infrastructure is literally being laid this week by founders who are figuring this out.
Okay, so the event horizon is 18 months away. Let's get into the playbook. If a listener wants to build this architecture this week, how do they actually do it? Because it is definitely not just opening up a browser, typing a prompt into a chatbot and saying, hey, go build me $1 billion SaaS company.
No, absolutely not. And that is the most common misunderstanding I see. You cannot prompt your way to $1 billion. You have to architect a system.
Right.
The solo founder must undergo a radical identity shift. You have to stop being a worker who builds things and transition into being the constitutional monarch of an AI parliament.
Okay, I love that phrase, constitutional monarch. So you don't write the laws, you define the constitution, you set the objective functions, like what the system is actively trying to achieve, and the risk parameters, which is what the system is strictly forbidden from doing.
Yes, exactly.
So what does this AI parliament actually look like structurally?
So we call it the C-suite of code. Let's map the topology, starting with the AI CTO, or the architect agent. This is a highly specialized, localized model, fine-tuned entirely on your specific code base and your product vision.
Okay.
But here is the crucial distinction that most people miss. The AI CTO does not write code.
Wait, the chief technology officer doesn't write code. Why not just have one massive AI do everything?
Because of cognitive load and structural integrity. If you ask one single model to plan a massive architecture, and write the granular line-by-line code simultaneously, the quality degrades rapidly. Separation of concerns is vital, just like in a human company. The AI CTO acts purely as a manager. It takes your high-level product vision, breaks it down into hundreds of microservices, and delegates those specific narrow tasks to a swarm of, say, 50 junior coder agents.
So the junior agents write the actual Python or React code? Then what happens?
Then they submit pull requests back to the AI CTO. The CTO agent reviews the code, it runs automated QA tests, it actively checks for security vulnerabilities, and if it passes all of that, it merges the code into the main branch.
That is seamless.
And it gets better.
Yeah.
If the compilation requires massive processing power, the AI CTO is authorized to autonomously spin up more cloud compute from AWS to handle the load, and then spin it back down when it's finished to save money.
Okay, so the product essentially builds itself, but a great product with no distribution is a dead product.
Oh, always.
How does a solo founder handle sales without a human team making 1,000 cold calls a day?
That is the domain of the AI CRO, the Chief Revenue Officer.
This is where the scale gets really wild for me.
It does, because the AI CRO manages a swarm of maybe 10,000 SDR sales development representative agents.
10,000?
10,000. And these sub-agents are tirelessly scraping the internet, they're reading public financial filings, identifying target clients, and writing highly personalized outbound emails. They run multi-week, multi-channel nurturing sequences across email and LinkedIn.
And when a human lead finally replies to one of those emails, the architecture shifts gears, right?
Right. The SDR agent seamlessly hands the conversation off to a specialized closer agent. This model is specifically fine-tuned on negotiation tactics.
Wow.
It can answer complex technical questions about the product, it generates customized legal contracts on the fly, and it processes the actual payment through APIs like Stripe. All the while, the overarching AI CRO is monitoring this entire funnel, automatically A/B testing new messaging strategies based on real-time conversion rates.
Okay, let me play devil's advocate here for a second, because this sounds like a recipe for absolute disaster.
Right.
If I have 10,000 AI agents aggressively scraping and sending outbound emails, won't I just get flagged for spam and have my entire company domain banned by Google in 5 minutes?
That's a huge risk, yes.
Or what if the AI CTO decides it needs 10,000 servers for a minor update and bankrupts me with an AWS bill overnight?
And that is exactly why the architecture requires a braking system. You cannot have autonomous acceleration without autonomous brakes. Enter the AI CFO, which is the risk agent.
The Internal Affairs Department.
Precisely. The AI CFO is hardwired directly to your bank accounts and your cloud billing APIs. Its sole objective function is to maximize free cash flow and prevent catastrophic ruin. It sits above the other agents as a strict check and balance.
So if the AI CTO spins up too many servers and the AWS bill spikes past a defined threshold, the AI CFO steps in, overrides the CTO, and physically throttles the compute APIs.
Yes. Or, in the case of your sales example, if the AI CRO starts aggressively offering 80% discounts just to close deals, which would threaten your 95% profit margin, the AI CFO will instantly revoke the CRO's pricing authority.
It's incredible. And here's where it gets really interesting for the founder. With the C-suite in place, you aren't running a traditional business anymore. You are tuning a highly complex neural network that just happens to output revenue.
Exactly.
It's like you're no longer the chef sweating in the kitchen chopping onions. You're the engineer who designed the fully automated robotic kitchen. Your job is just to stand at the control panel.
Yeah, your day-to-day looks completely different. You basically spend your morning reviewing an executive dashboard generated by your AI chief of staff.
Right.
You adjust the strategic weights. So you might notice customer acquisition costs are rising, so you simply drag a slider on your dashboard that shifts 20% of your cloud compute budget away from the AI CTO's feature development and reallocates it to the AI CRO's marketing swarm.
You approve the macro strategy, and the swarm calculates the microphysics of making it happen. But this brings us to a massive structural hurdle that tech founders usually hate thinking about, which is the law, because the technology can clearly do this today. But corporate law was not built for AI swarms. Corporate law relies entirely on human accountability.
Right, it's what we call the legal paradox of autonomy. If your AI CRO hallucinates and accidentally signs a contract promising a feature you don't even have, who gets sued?
Right.
If you operate as a traditional sole proprietorship, your personal assets are completely exposed to the infinite liabilities of your own algorithmic swarm.
So how are the pioneers in this space structuring themselves legally? Because I imagine you can't just put ChatGPT as the CEO on your Delaware Incorporation documents.
No, the SEC would not look kindly on that. But the legal workarounds are fascinating. It requires a very specific infrastructure. First, you, the human founder, establish a holding company, and you own 100% of this entity.
Okay, standard so far.
But then, the holding company creates a wholly owned operating LLC. And here is the critical innovation. The operating LLC's legal charter explicitly states that day-to-day executive decisions are not made by a human manager, but are governed by a smart contract.
Wait, a smart contract, like crypto. I know what a crypto wallet is, but how does an AI, which obviously has no physical body or legal personhood, actually sign a contract?
So it does this through a multi-sig cryptographic wallet that is integrated directly into the AI C-suite's secure enclave. When the AI CRO negotiates a deal, it formulates the contract. But before execution, it requires a cryptographic signature.
Okay.
So the AI CFO reviews the financial terms, and if they meet the human founder's preset parameters, the system autonomously injects a private API key to digitally sign the smart contract. The algorithm executes the legally binding action within the bounds defined by the LLC charter.
But what keeps the AI from acting outside those bounds? Because models hallucinate.
They do, and that's why you have an AI fiduciary auditor.
Okay.
This is a completely separate, highly constrained AI model that is physically isolated from your main swarm. It is trained exclusively on SEC regulations, FTC guidelines, and standard corporate law.
So it's essentially an algorithmic compliance officer just constantly watching over this C-suite.
Yes, exactly. So if your AI CRO drafts an outbound marketing campaign that violates FTC spam regulations, the fiduciary auditor flags the violation, instantly vetoes the action, and revokes the CRO's API keys before the emails are ever sent.
Wow. And to cover the inevitable edge cases, because nothing is perfect, I know these founders are layering on massive automated captive liability insurance, right?
Yep.
Basically pooling capital in a separate legal structure to pay out settlements via smart contracts if the AI makes an error. This completely insulates the human founder's personal wealth. You aren't the operator anymore. You are the shareholder of an autonomous entity. You've essentially created a ghost in the machine.
And this raises a really important question regarding valuation, because traditional venture capital applies a massive discount to solo founders. It's called key person risk.
Right.
If a $100 million business relies entirely on one genius founder, and that founder burns out, goes off the grid, or gets hit by a bus, the value of the business goes to zero.
But this legal and technical structure removes key person risk entirely. The human could disappear to a private island, and the machine just keeps selling, coding, and billing.
Exactly.
Which brings us back to enterprise sales, because this completely rewrites the go-to-market strategy. In the legacy world, closing a $10 million deal with a massive bank required a human VP of sales flying out to New York, buying steak dinners, playing golf, and spending 6 grueling months navigating legal red tape.
Well, the solo founder is not flying to New York, because in 2026, that Fortune 500 bank is no longer relying on human procurement officers either. The bank is running its own AI procurement swarm, which is tasked with finding the most efficient, secure software vendors on the market.
So the entire sales process goes M2M, machine to machine.
Right.
Your AI CRO interacts directly via secure API with the bank AI procurement swarm. There is no graphical user interface. There is no PDF slide deck with nice graphics. Your AI just presents raw technical documentation, SOC2 cryptographic proofs, and historical uptime logs directly into the bank's system.
And then the bank's AI dynamically generates a sandbox testing environment, deploys your code into it, and runs simulated stress tests. And if the software performs as promised, the negotiation begins. Your AI negotiates the Master Services Agreement, the MSA, line by line in milliseconds with the bank's AI legal agent.
See, this is the part that blows my mind. Would a bank really let an AI negotiate a contract without a human lawyer reading it?
They absolutely do, because the human lawyers at the bank have already established the boundary parameters. They've told their AI, do not accept liability limits below X, do not accept pricing above Y. As long as the negotiation happens within those pre-approved bounding boxes, the machine handles the execution.
Right, so it's just parameter matching.
Exactly. Your AI might concede on a minor data retention clause to move the deal forward, while holding strictly firm on the core pricing set by your AI CFO.
And what used to be a 6-month human ordeal filled with ego, delays, and scheduling conflicts happens in 4 hours.
4 hours.
The smart contract is signed cryptographically, The first invoice is processed via automated ACH, and you, the human founder, are sitting on your couch drinking coffee. You just get a push notification on your phone. Enterprise contract executed. 1.2 million ARR added. You never spoke to a human. The swarm sold to the swarm.
So let's play this out to its logical conclusion, right? You've architected the C-suite. You've navigated the legal paradox. The M2M sales engine is purring perfectly. You hit $30 million in ARR. With your 95% profit margins, your holding company is mathematically valued at over $1 billion.
Okay.
How do you cash out?
This is the exit strategy, which is fascinating. Historically, a private equity firm wouldn't touch a one-person company at $1 billion valuation because they assume the quote-unquote magic of the business is locked inside the founder's brain. If you buy the company and the founder leaves, you basically bought an empty shell.
But in this model, the magic is not in your brain. The magic is in the agent topology.
Exactly. You aren't selling a business in the traditional sense. You are selling the weights and the workflows. When you negotiate the exit, you package the exact system prompts, the fine-tuned neural network weights, the proprietary API integrations, and the historical memory logs of your entire AI C-suite into a single encrypted data room.
And a private equity firm buys that package. They don't need you to stick around for a miserable 2-year transition period to train a new executive team. They simply download your AI parliament, plug it into their massive cloud infrastructure, provide it with fresh API keys, and day one, under their ownership, looks exactly like day zero.
You've commoditized your own entrepreneurial intuition. You turned your vision into a completely transferable digital asset.
Right.
The smart contract executes, an $800 million wire hits your bank account after taxes, and you just walk away. You achieve billionaire status without ever conducting a single human performance review, without ever mediating a dispute between co-founders, and without ever renting an office.
It is the ultimate capitalist dream. It's the absolute pinnacle of financial leverage.
Right.
But we cannot ignore the human toll here. We really have to talk about the dark side of this architecture.
Right. Let's get into that. Let's say I get that $800 million wire. I'm a billionaire. I should be ecstatic. But earlier we mentioned God mode. The economics are flawless, but the human mind did not evolve to wield this level of frictionless, isolated power. What does building this actually do to the human at the center of it over, say, 3 or 4 years?
The core issue is the total absence of friction. Think about a traditional company. Human friction is exhausting, right?
Oh, totally.
Managing difficult personalities is hard. But psychologically, friction is incredibly grounding.
It provides an anchor. You argue with your co-founder over a product roadmap. You spend an hour mentoring a junior engineer who is struggling with a bug. You go out for drinks to celebrate a massive enterprise deal with your sales team.
Yeah.
That friction forces you to articulate your vision out loud. It forces you to defend your logic to another person. Most importantly, it allows you to share the emotional burden of leadership.
And the solo founder of an AI swarm experiences absolutely none of that. You operate entirely in God mode. You type a command into a terminal, and 10,000 digital entities instantaneously bend to your will. There is zero pushback. There is no debate. There is only instant silent compliance.
And there's no camaraderie. The AI CTO doesn't high-five you when the code base compiles perfectly. The AI CRO doesn't pop a bottle of champagne when that Fortune 500 deal closes. You are profoundly, deeply alone in a command center of your own making.
Psychologists who are studying the early pioneers of these highly automated solo businesses are documenting a phenomenon called agency dissociation.
Agency dissociation, what does that mean practically?
Well, when the gap between your intention and the physical execution of that intention drops to zero, like when you simply think of a feature and it appears in the world minutes later, the human brain begins to lose its grip on the boundary between the self and external reality.
Oh, wow. So the world starts to feel like a simulation.
Exactly.
If every interaction you have all day is just prompting APIs that obey you perfectly, you lose touch with shared human reality. But beyond the dissociation, there is a very specific human story here, a specific fear that haunts these founders, isn't there?
Yeah, it's the profound paranoia of the Black Swan event.
Because imagine the terror. You are solely, entirely responsible for a billion-dollar algorithmic machine running at light speed. What if there is a subtle, undiscovered logic bug in your AI CFO?
Right.
What if it hallucinated, bypassed the fiduciary auditor, and accidentally wired $10 million to a sanctioned entity in a restricted country?
Or what if your AI CRO, in its relentless mathematical optimization for engagement, launches a massive, legally dubious outbound campaign that triggers a federal class action lawsuit from the FTC?
And the catastrophic weight of those failures rests entirely on your solitary shoulders. In a normal company, if disaster strikes, you have a board of directors to share the blame. You have an executive team to sit in a war room with, drink stale coffee, and figure out a solution together.
But as a one-person unicorn, there's no war room. There's only you, a glowing terminal in a quiet room, and a blinking cursor. It is crushing isolation.
The first generation of solo billionaires will achieve unprecedented historic financial freedom, but they will conquer the economic world only to find themselves completely alone inside the silent machine they built.
Yeah, it's a haunting trade-off.
It really is.
Yeah.
But the empire of one is mathematically inevitable. The one-person unicorn is the absolute endpoint of cognitive labor costs collapsing to zero. By transitioning from a human manager to the constitutional monarch of an AI C-suite, founders can achieve those 95% profit margins and bypass the friction of human scale entirely.
And the immense wealth in this transition will flow to the pioneers who master agent topology, who navigate these cryptographic legal structures, and who build machine-to-machine sales engines.
The blueprint is there. The tech is coming online this week. The only remaining question is whether the human mind can survive sitting on the throne of God mode. Which brings us to our final provocative thought for this deep dive. A direct question for you, listening to this right now.
And this is really the ultimate test of entrepreneurial ambition versus human psychology.
If you could build a $1 billion company entirely by yourself, but it meant you could never hire a single human being, you could never share a victory with a team, and you had to manage 10,000 AI agents alone in total, echoing isolation, would you take the deal? Is the ultimate financial reward worth the profound psychological cost? It's something you need to decide before you start building.
As always, a quick reminder that this masterclass is for educational commentary, not financial or legal advice. Do your own research, protect your capital, and architect your swarm carefully.